Welcome to The Explainer. Today, we're looking at what is arguably the most compelling corporate turnaround story in Europe right now, UniCredit. We aren't just looking at a bank that recovered from past struggles, we are looking at an institution that is actively executing a massive, high-stakes acquisition, one that could completely redraw the map of European banking.
Okay, let's dive right into this with a single, absolutely staggering number, 6.3 billion euros. Now, you might be thinking, that's their annual revenue, right? No way. That is literally just the bank's net profit for the first half of 2026 alone. That's a 3% increase year over year. This tells us right out of the gate that UniCredit is not in some cautious recovery mode. They are absolutely firing on all cylinders. But what they actually decide to do with this massive pile of cash, well, that's where our story really begins. To unpack this mega deal, we're taking a methodical approach today. First, we'll look at the data proving UniCredit is a profit-making machine. Second, we'll break down the Commerzbank takeover. Third, we'll take a sobering look at what could actually go wrong. And finally, we'll give you our boardroom-style verdict.
So, let's get into part 1, a profit-making machine.
Like I just mentioned, that 6.3 billion euro net profit in the first half of 2026 was supercharged by a massive 2.9 billion euro second quarter. They just completely blew analyst expectations out of the water. But the real story here? Consistency. UniCredit has now delivered 22 consecutive quarters of record earnings. How are they pulling this off? It really boils down to highly diversified revenue streams. Think rising fees, not just traditional lending, combined with this ruthless discipline regarding operational efficiency and a really strong showing in capital markets across Italy and Europe.
This momentum gets even crazier when you look at the profitability metrics. Take RoTE, or return on tangible equity. Basically, this measures how well a bank turns its core assets into cold, hard cash. UniCredit hit a staggering 23% in the second quarter. To put that into perspective for you, most European banks are popping champagne if they can just hit a 12 to 15% average. Hitting 23%? That means this bank is an absolute cash machine. Another vital piece of the puzzle here is their CET1, or Common Equity Tier 1 ratio. You can think of this as the bank's financial shock absorbers. It represents their core capital resilience. As of the end of June 2026, UniCredit is sitting at a very healthy 14.3%, which is way above regulatory requirements. And this is totally crucial, because having that massive buffer is exactly what gives them the financial firepower to make their next incredibly ambitious move.
Which brings us to part 2, the Commerzbank takeover.
This takeover is the real narrative engine of our story. UniCredit CEO Andrea Orcel is taking that financial firepower we just talked about and launching a bold, cross-border takeover of Germany's second-largest bank. Through a tender offer, UniCredit was originally set to grab roughly 48% of Commerzbank. But because Commerzbank recently canceled its own treasury shares, UniCredit's effective stake instantly bumped up to 49.65%. I mean, they're a hair away from majority control. And right now, they're actively negotiating for that 12.7% residual stake still held by the German government.
So why go after Commerzbank? Well, it is a strategic goldmine. Germany is Europe's largest economy, which is a market where UniCredit has historically been a bit underweight. This deal gives them instant scale, a formidable corporate banking franchise, and millions of new retail customers. Just looking at the numbers, UniCredit expects 1.2 billion euros in pre-tax synergies from this stake alone, which generates a really attractive 15% return. And if they can achieve a full merger, we're looking at a path to a staggering 21 billion euro group net profit by 2030.
But look, an ambition of this scale isn't exactly free. There's going to be some necessary short-term pain for this long-term gain. To actually fund this, UniCredit had to immediately hit pause on a massive 4.75 billion euro share buyback plan. And remember those financial shock absorbers? Their CET1 ratio is expected to drop from that comfy 14.3% down to around 13% by year-end. Plus, integrating these giants means enduring 2 to 3 years of parallel operations before a full merger is even on the table. Still, management is so incredibly confident that they've already upgraded their 2026 net profit target to 11.5 billion euros, and that's explicitly excluding the integration costs.
All right, let's move to part 3, what could go wrong? Whenever we see a mega deal like this, we really have to stop and ask the crucial question. Is a cross-border banking merger of this magnitude actually worth the massive looming risks? Because let's be real, the history of European banking is littered with mergers that looked fantastic on a spreadsheet, but completely fell apart in execution.
Looking impartially at the reality on the ground, UniCredit faces 4 major hurdles. First up, capital pressure. That 13% CET1 ratio we mentioned, that's their floor. If integration costs start to balloon, they could face some serious constraints. Second is the integration itself. Rating agencies are already warning about cross-border cultural clashes, and labor representatives are bracing for up to 23,000 potential job cuts. That's a huge human cost that will be fiercely resisted. Third, we have politics. Navigating the German unions and politicians who oppose foreign ownership is going to be a bureaucratic boss fight. And fourth, timing. The exchange offer doesn't even officially settle until 2027. That means investors are being forced to play a very long waiting game.
Which brings us to part 4, the final verdict.
So, how do we weigh those massive political and operational risks against the momentum of a cash-generating machine? Let's just let the data speak. Looking ahead to 2028, the stock currently trades at roughly 11.6 times forward earnings for 2026. But as those Commerzbank synergies actually materialize, that multiple is projected to drop to just 7 times earnings by 2028. Meanwhile, the dividend yield is projected to grow from a very generous 5.4% to over 6.4%. Simply put, this stock is remarkably cheap for a bank that is delivering double-digit earnings growth.
And you know what? Wall Street is overwhelmingly backing this play. Just look at the major players. Bank of America actually calls UniCredit their favorite European bank stock, giving it a €100 price target. Barclays is targeting 94.50, and JP Morgan is right there at 94. The overall analyst consensus is a resounding buy, with an average target of 91.30 euros. That essentially means, even when you factor in all those risks we just talked about, the street still sees a minimum 7% upside from current levels. To really visualize the stakes here, let's contrast the two extremes. Over in the bull case, integration goes smoothly, synergies hit their targets, and net profit skyrockets up to 14 billion euros by 2028. The stock re-rates, offering a massive 25% or more upside. Now, in the bear case, integration stalls out, costs blow up, and capital stays pressured. But here is the kicker. Even in that absolute worst-case scenario, the stock is only projected to trade down to around 77 euros. That is a relatively capped downside of roughly 10%.
So when you mathematically weigh that massive upside against the capped downside, the core takeaway is this ratio, 2.5 to 1 in favor of the upside. For patient investors who can stomach a bit of near-term uncertainty, the core business is just simply too strong and the valuation is way too cheap to ignore.
We are quite literally watching history unfold in real time. If UniCredit can successfully navigate the politics, appease the unions, and untangle this incredibly complex integration, will this bold gamble permanently reshape the entire European financial landscape? The math certainly says yes, but only time will tell. Thanks for joining us for this explainer, and we will see you next time.